Liquidity is one of those concepts that everybody loves talking about, but very few people actually provide the explanation behind why and how it works. In this video, I'm going to simplify liquidity so you can understand why markets react at specific levels and how to take advantage of it. But before we get into the video, let's think about this. What is a market? Think of a market like one big arena where buyers and sellers are fighting with each other to get the best price for their order. Just as an example, if I was a car dealer, I want to sell the car for the highest price possible. But on the other hand, if I'm a car buyer, I want to buy that car for as little as possible. So I want you all to take a look at this order book image and keep it in the back of your mind as we go through this video. Also, if you're new to the channel, make sure you download my simple trading framework PDF. I'll leave a link in the description. So without wasting any more of your time, grab your notebooks and let's get into the video. All right, so we're going to talk about liquidity and try and simplify things so when we're looking at the charts, we know exactly what is going on and we're a little bit more confident in understanding why a market moves to a specific level. So if you haven't already seen what an order book looks like or a time and sales sheet with a level 2, basically what happens is when I come to the market and I place my order is going to hit the order book in the form of a market order or a limit order. And inside of that order book, we're going to have resting orders. So every other participant, if it's a centralized feed, right? Forex, we don't have a centralized feed, so we're not getting an order book unless we actually find a way to get that from our brokers. But the brokers don't share that information. But with futures, stocks, etc., you can see all the orders on the order book. And when we're looking at a chart, that's just a representation of all the orders that are being filled. So not only do we have the order book, but we have a time and sales. So when we have each order getting paired at current market price, right? A bid will match an offer, and that time, that transaction will be listed in the time and sales sheet. So what exactly is liquidity? Liquidity in an order book is a key factor in trading because it indicates how easily an asset can be bought or sold without significantly affecting its price. The depth of an order book, which is the number of buy and sell orders at different price levels, is a key component to measuring liquidity. So a deep order book with a high volume of orders at each price indicates a highly liquid market. And in a market like FX, right, this is why we see a lot of ranges, is because there's a lot of volume and a lot of transactions being, occurring on both sides of the market. So when we are stuck in a range, really, what does that mean? And the goal of this video, right, is to just get you guys to visualize liquidity when you're looking at a chart. And I think this is where a lot of educators and a lot of different traders go wrong, is they just see candlesticks for what they are without painting the narrative behind what's going on. And what I've done a lot in my journey as a trader was just listen to podcasts, watch a ton of videos just from back in the day, right? And just imagine yourself as if you were on the floor of the exchange. And let's say, before there was the age of the internet, you had to be on the floor to transact. So really, when you're looking at a chart, that's just a representation of all the traders that are connected online through these internet markets. But before, when we were on the floor, I could see everybody in the pit and I could see all their orders. Possibly, right? If I knew what they were trying to offer or bid, they might say, I want to buy 100 lots at this price. I can see that order because the guy's standing right in front of me. Whereas now, a lot of that information is being lost because we're just looking at a screen. So one really good YouTube video that I've watched a ton is called Floored. It's a documentary. You guys can look it up. But really put yourself in the shoes of a floor trader. A lot of these guys, yes, were hunting stops. They would prey upon the weak people. But then when they transitioned to electronic markets, a lot of them could not cut it because they couldn't take the emotions of the pit and translate them to the chart. And that's what liquidity is, really, right? Liquidity is just people operating in the market, right? Different participants in the market. So let's talk about, why specific markets move and, how to visualize this. So right here, just as an example, right, we're just looking at the euro, but it doesn't really matter what asset we're looking at. We can just hide the symbol if we want. If we are going to recognize liquidity, right, and put ourselves in the shoes of somebody that's a smart money trader, right? What is the narrative that I'm getting from these markets, and what's happening when they run below old lows and they run above old highs, right? So let's just say, for example, we're in this specific range. Now, how is price going to react based on what we're looking at in the order book over here? So just pretend this is our order book, right? We have offers over here, which, let me write this out. So we have the ask price and then we have bids. So bids are below the market, right? Because they're trying to get the cheapest price that they can. And sellers are willing to sell it at a specific price, but they're only willing to go so low. And think about yourself as, again, a car dealer. And let's say we're selling Lamborghinis, right? and there's 10 dealerships on this one road, but one of the dealers is selling it for 80,000 and the others are selling it for 100,000, just hypothetically. There's only one dealer that's selling it at 80,000 and he only has so much inventory, right? Let's say he's got 10 Lamborghinis, right? And he's trying to buy them at 80,000. But some buyer comes in, right? And he wants to buy 20 of them at 80,000. Well, the dealer does not have enough inventory to sell him 20 Lamborghinis. So he has to go to the next dealer and try and negotiate that price down, okay? And let's say there's more and more buyers that step into the marketplace and are willing to buy Lamborghinis at that same price, right? But there's no inventory. The only way it's going to be able to change is if the sellers are willing to reduce their price or if the buyers are willing to increase their bid, right? And that's just the simple mechanics of a market. All right, this is an auction, but sometimes when we sit in front of the charts, we lose that narrative. We totally forget that this is what's going on behind the market. Okay, so when a big buyer comes in and can sweep a lot of the offers, right, it's gonna make price jump very quickly. And this is what understanding liquidity is, and having liquidity voids and inefficiencies and old highs and old lows is because there's a specific amount of demand or supply, whatever you want to call it. Yes, ICT might throw a fit from listening to this, but it doesn't really matter at this point. This is how I visualize the market and how I can align myself with the market. It doesn't really matter what's going on behind the scenes. I'm just trying to be confident in my trade setups and really put into perspective what is going on, because essentially a market is just people battling each other. So just imagine that there's all these people just in line, right? Let me try and copy all these. Just imagine there's all these people in line waiting to buy a car, right? And the dealers are up here saying, blah, blah, blah. Well, when this order book thins out, right? Let's say this 20 lot and this 120 lot, let's say that there's 140 people willing to buy a Lamborghini at 80,000. They're going to eat up these three orders very quickly unless new offers come in, because the order book is constantly moving, right? So let's just say these three orders just disappear, right? Now we still have, let's say there's this order got filled. Let's say the 20 lots got filled because some of these dealers were willing to come down, or that 20 lot order was willing to increase their bid, right? So if they couldn't get it for 80, maybe they're going to buy it for 90. They were negotiating, right? So there's the spread. Now let's say that there's 80 lots left on a willing buyer, right? And more buyers keep appearing, but not enough sellers keep appearing. Right? And this is a little bit different than what you're used to seeing in liquidity video, but I don't think enough traders are going in depth of why this actually works. Yes, we can plot old highs and lows, but how can we be confident in understanding that this might be a liquidity raid and where is the next target of liquidity, right? And this is trying to simplify it. When you're, looking at markets where they're so complex and you're trying to learn all these different things, let's just try and simplify and go back to the basics, right? What is a market, first of all? So now we still have 200 people that are willing to buy a Lamborghini, and they might have to raise the prices a bit. So not only that, but all of these have to get raised up. So this price will go up, right, to maybe 107, 109, 790. This will go up to 109, 800. But let's say there's not enough sellers. Nobody's willing to sell it at a specific price. The next level that people are willing to sell their Lamborghini for is, let's say, 115,000. And let's just say that it is 1.106. All right, just theoretically, right? This is when you're going to get possibly one big buyer if there's enough of an interest. And let's say that this market isn't moving, and this is where you're going to get liquidity, some fair value gaps, is because there's no liquidity. So if there is liquidity, right, if more and more people, let's say that people keep stepping in and keep offering it, and they keep offering their Lamborghinis at let's say 90,000. Well, they're going to be able to keep suppressing price. So when a market is stuck in a range, right, we have an even amount of bids versus asks. So each time a bid gets filled, right, a new ask will take its place. But when the order book thins out, that's when you're going to see, if there's enough buying interest, you're going to see quick prints like a fair value gap. And some people call them single prints. And this is just something that you guys could study if you really want to. Go into a level 2 and a time and sales and watch to see if there's single prints that cause the market to jump, right? You might have a big buyer step in and say, well, you guys are not willing to buy it at, let's say, 100K, that Lamborghini, let's say it's 100K right here. Some guy is going to just skip the line. And that's why it's a single print, because some guy is just going to be like, all right, I have the money. I'm just going to come in and buy it at the ask because this market's not coming down, right? But if there's no willing buyers, then the market will start coming down, okay? Because the sellers are not going to hold on to their inventory forever, right? And it's just simple market mechanics. When we're thinking about liquidity, this is what we need to be focused on. So when we're looking at the charts, just try to not see the candles for what they are. Try and visualize past the candlesticks, because that's really the indication of liquidity. When we get single prints or really quick moves, it's because there's an imbalance between buyers or sellers. All right. So this was just a really quick video, but I hope you guys gleaned something from this and were able to learn a little bit more about, you know, how a market operates, because everybody should know how a market operates. It's very simple. If I'm a buyer, I want to buy it at a specific price, and I'm not willing to go over a specific price, and there's a seller out there that is not willing to go below a specific price. Okay. So when we have, you know, old highs and old lows being stacked up, you know, there's a lot of sellers that are not willing to sell it until it hits that level. All right. So when we're, you know, when we're sitting down in front of the charts, try to like really visualize, you know, what is the market currently doing? Because when it's stuck in a range, a lot of times it's just buyers and sellers going at it, you know, basically just a battlefield. Just think about buyers and sellers, that people are constantly buying and people are constantly selling. But as soon as the people that are selling stop selling, now there's too many buyers, right? And now the price of things go up. You guys saw it with COVID. I mean, it's just simple market mechanics, right? When toilet paper was extremely low, right, those prices just jumped up because there's so many buyers and not enough sellers, right? They're basically single printing toilet paper. So, you know, this is really just to simplify liquidity. So when you're watching videos out there and you're trying to understand liquidity and it still doesn't make sense to you, go back to the roots of what liquidity is. And liquidity really is just people, right? And the size of their orders. And when the markets thin out on one side or the other, right? Let's say if there's too many sellers and there's not enough buyers, well, it's going to be a race to the bottom, essentially, for the sellers to keep lowering that ask price. All right. So let's say if, you know, people are only in the market to buy a house for 100K, but there's all these people willing to sell it at 300 and nobody can sell their house. What is the most logical thing if the bid is not moving, right? The bid is staying the same. There's not enough people bidding on it. Maybe there's one sucker that gets caught out, right? And they're going to buy that house. But the majority of the time, right, that's kind of the current market. The spread is too big, so one or the other has to give way. And when the spread is too big, it's who's going to come down first or who's going to raise their price first. You know, if there's more people raising their price, that means there's demand. And if there's not enough people lowering their price, there's too much supply. Yes, it makes sense, but for some reason, ICT traders just think that it's all just nonsense. You can use ICT concepts in conjunction with the actual market mechanics, right? And be way more profitable because you can understand how the market is operating. And you're not just so stuck in pattern trading or just stuck on the screens. Because again, if you watch the Floor documentary, I'll leave a link in the description, guys. If you watch that documentary, there were some traders that could not transition from the floor to the electronic trading screen because they're not getting the emotion of a real market. You know, if you go into, it's way different if you're buying a good online or buying something online. You don't get that emotional feel from as if you were there in person, right? And it's the same thing with when COVID happened, right? When you saw everybody in store panicking for toilet paper, there you can read the emotions. But if people were to just tell you we're low on toilet paper, you just see it online, you don't get the same emotional effect from it, right? Because that's how liquidity is being affected in the markets. It's right now it's all electronic, but trying to put yourself in the shoes of somebody that is actually on the floor is going to put you so much further ahead than as if you just looked at these old highs and these old lows and didn't go past that, right? Because you're trying to be a little bit more complex than just a monkey clicking buttons, right? You're trying to understand why a market is moving. You're trying to understand where the next level is going to take place, right? Where let's say if I'm bearish on the euro and I think it's still going to go lower, this is a replay, by the way. This is all the way back in August 2023. But if I think a market is going to go lower, I'm assuming that there was enough sellers that came in here and were willing to sell at this price. Let's just say that there was 600 people willing to sell their Lamborghini at that price. That's just my thought process because I'm not there in person. I can't see them. My thought process is, okay, once we ran above that old high, all right, we filled enough orders, but I still have a whole warehouse of Lamborghinis. That's the concept that I'm trying to convey to you guys when it comes to understanding liquidity is, are there enough willing participants at a specific price point for a market to either reverse or it's a fake out, all right? Because as you can see here, this was just a fake out. But understanding that, you know, we're running below an old low after displacement, right? There was a single print here, or a couple single prints, where there was a massive imbalance where buyers stepped in the market and they were just eating up the offer, right? And, you know, that's basically all I try and think about when I'm sitting in front of the screens. It's way beyond just ICT concepts. It's what's the narrative behind this, which I'll dive into a different video. But this helps with my narrative, understanding liquidity and why a market should move, and understanding the order book, even though I'm not looking at the order book, understanding how it actually works, right? Because I did try and study time and sales in level 2 for a little while. I might get back into it with footprint charts or whatever the better tool is out there. But in the FX markets, we don't get that information. So what I had to do was try and train myself to understand it, even though I didn't have the information. So I hope you guys enjoyed this video and learned a little bit more about liquidity. If you're interested in possibly trading live with me and learning with me weekly, make sure you check out the link in the description. Also, don't forget to like, comment, and subscribe, and I'll see you guys in the next video.